If you're thinking about getting a loan, I've got the Queen of Financing with me, Theri Isaacs, and she's with Northpointe Mortgage. And you may be wondering, what type of loan can you get? What can you qualify for? So we're going to run through the major types of loan financing programs that you can qualify for. So stay tuned, you're not going to want to miss this. All right, so I got Theri with me, and I've been working with Theri for a couple years now. I love how she works with my customers. She pretty much gets all my business because she can loan for FHA, VA, condos, everything under the sun, okay? So we want to touch on like basically the top 3 financing type of programs. So if I get a buyer that calls me and they say, hey, we're looking to buy our very first home, so they're super excited and of course super nervous because they've never done it before. They said, I want to qualify for one of those first time home buyer programs. Well, that would be FHA.
Correct.
And so FHA, I'll have Theri talk a little bit about what are just the overall parameters of an FHA loan.
Yeah, so an FHA loan is a low down payment program that allows first time home buyers to get into a property with only 3.5% of the purchase price down, or the appraisal, whichever is less. So 3.5% down. It is there are no income limits, and so it really, from a buyer standpoint, it kind of opens the door for a lot of folks that even if it's not a first time home buyer, this is a program that anyone can actually use as long as it's a primary residence. And then there are some purchase price limits. We tend to do okay in this area. They are county specific, but FHA is really that go-to program for your first-time home buyers or low down payment buyers.
And it has more flexibility in like as far as income to debt ratios.
Yes,
it can kind of it can go higher as far as your debt to income ratios than other loan programs can, right?
Right. Yeah, where your normal programs like conventional and things of that nature will have a 50% maximum debt to income ratio. We do have, and we have seen some flexibility in getting approvals for folks who are creditworthy, who have good credit scores. We have seen a scenario where we are able to get them approved to be over that 50% debt to income ratio with an FHA program.
So you're going to need your 3.5% down. You're also going to need roughly 3.5% for closing costs as well. So take that same purchase price, do another 3.5%. That's going to cover your closing cost, the title fees, your prepaids with taxes and insurance, the whole 9 yards. So that if you are just starting out and you aren't sure what you can afford, number one, or what those costs are really going to be, or what your payment's going to be, Theri's your go-to person because she can answer all those questions for you so you can know how much money you're going to need to save up and how much that payment's going to be every month and what you can truly comfortably qualify for. Then you go out and you start searching for a property. You call me. And then you start searching for a property.
Well, and Sharon, another program that a lot of people ask questions about or may not be necessarily familiar with is VA financing. Mm-hmm. VA financing is something that we do as well, and it is for folks that qualify for VA financing, and we can do those loans traditionally with 100% financing, where the borrower is coming to the table with no money down, but that doesn't necessarily mean no money to the closing table, because there are still closing expenses and prepaids that have to be brought to the table for VA. And one of the other things about VA is, to note that if you are in a scenario where you could put some funds down in a VA, you could actually help reduce some of those VA funding fees that are associated.
And so that's sometimes also a misconception because veterans will say, well, I'm in the house for nothing. And I'm like, well, that isn't exactly how it works. There's no down payment, but there are those closing costs. So again, you still have those 3.5% closing costs. Now, I can say that, in the current real estate market, there have been some recent opportunities where sellers can help provide some of those closing costs. So if you have a savvy realtor, they can hopefully negotiate some seller paid closing costs, either just as part of the contract, or in some cases, if it makes sense and the property will appraise, bring the price of the home up a little bit to then cover those closing costs. And it really takes the listing agent to explain to their seller how that can be a benefit for them. So, and right now with interest rates have gone up some, obviously, you know, there's even more of an opportunity to maybe get some seller paid closing costs. So the other big loan type is the conventionals. That's kind of the big boy blanket, covers everything. So Theri, break it down and tell them, like, from a percentage standpoint, how much do you need down for, you know, the type of conventional loan you're getting?
Yeah, so conventional loans are reserved for houses and townhouses. Those property types, those specific types qualify for the conventional financing. For conventional financing, you have three different property types. You have primary residence, you have a second home, and you have investment property. Pretty much all self-explanatory, but primary residence with conventional, which is a Fannie Mae, Freddie Mac loan scenario, you can get in with as little as 5% down. Second homes, you can do 10% down. Investment properties are 15% down. We talked a little earlier about condos, though they aren't a Fannie Mae program. My specific program allows for 20% down. So we've got a 5, 10, 15, and 20% down program between first home, second home, investment property, and condos.
And if you put down 20%, that's where you really benefit, because you don't have the...
Yeah, on the conventional programs, anytime that you put less than 20% down, there's a private mortgage insurance premium that's going to be added to your payment. So if you have the ability to put 20% down, you can actually avoid that premium being added to your payment.
And there's a point at which that falls off after you have 20% invested in property, but it's a long ways down the road.
Well, you have to pay. You have to pay it for 2 years. It's a mandatory pay for 2 years. If you do something such as a lump sum and things of that sort, where you are moving that loan amount down to less than the purchase price or the current value of the property, you can appeal to the mortgage company to have that PMI removed, but you are locked in for the 2-year time period. With no exceptions.
So obviously your expert go-to is going to be Theri. She's going to be able to walk through, depending on, you know, if you're looking to purchase something for yourself, what your ability is from, you know, a payment standpoint, and what type of loan is going to be the best for you, because there's all different kind of intricacies with all of these. And she'll be able to point you in the definite right direction. She's been in this industry for over 30 years. I've been in real estate for over 17 years as a full-time realtor. So whether you start with me and go on my website, sign up and start a search, and then give me a call, or you contact Theri first, which if you contact me first and you haven't talked to a lender, I'm going to put you with her anyway. So you might as well just reach out to her first and get all those questions answered, and put you in a good comfort zone, a good little place feeling wise, because they actually offer this really cool thing called True Approval, Northpointe True Approval, which we talked about in an earlier video. So make sure you go through and you're subscribing to my YouTube so you can get all these good educational videos. If you have any questions, reach out to her. All her contact information is at the end of this video. Thank you guys so much for watching. We appreciate it, and have a wonderful day from Panama City Beach, Florida. Bye.
Bye.